Thanks for clicking. My name is Mark Mitchell. I'm a mortgage broker here in London, Ontario. StatsCan released the inflation data this week, and as expected, it's much higher than we would hope for. And it's very likely that that's going to change the Bank of Canada's plan for raising interest rates, which it had not planned to do for at least a few quarters. So what I want to do today is go over the inflation data just released, how this should affect interest rate policy, and why this could be a very big problem for holders of Canadian real estate, especially those in variable rate mortgages. It was also announced today that we're going to have an update on the Bank of Canada's monetary policy report next Wednesday, the 27th, and we are also going to have our China update on Friday of this week as the impending real estate crisis continues to get worse. Click like and subscribe to get those updates, but for right now, let's get into the inflation data. So Canada's inflation went up to 4.4% as released today. Last month it was only 4.1%, so we're definitely picking up speed. This is the highest inflation that we've had in almost 2 decades. And it's not looking like it's going to get any better anytime soon. If you've been to the pump lately, you can see that gas prices have shot through the roof, especially over the last few weeks. And while inflation data doesn't get updated right away, as gas gets higher and higher, that's going to feed into our inflation data, and prices are going to go up even more. Probably, but as gas prices gets higher, we can expect inflation to go up even further in the coming months ahead.
Oh, crap.
So not great news price-wise. As we know, inflation does erode the value of people's savings and makes it so that you can't buy as much. But this inflation data is going to cause a real problem for the Bank of Canada as well. The Bank of Canada, for its part, is hoping that the inflation wasn't going to be too hot, as we're still recovering economically, and it doesn't want to raise rates for fear that that's going to stall our economic recovery. So it was hoping to raise rates later in 2022. But given that our inflation is already at 4.4% and is expected to get higher sooner rather than later, it could force the Bank of Canada's hand to raise rates earlier in 2022 or maybe mid next year as well. So that could turn out to be a big problem as we're still trying to recover economically. We're still hoping for business investment and for everyone to get back to work. The CRB is set to expire very soon, so we're about to see the consequences of that as well. And if the Bank of Canada is forced to raise rates in order to tamp down that inflation, as it doesn't want to see inflation get out of control, it's going to cause a real catch-22 for the bank.
You're damned if you do, and you're damned if you don't.
Do they try to prevent hyperinflation, or do they allow our economy to recover? So this definitely isn't great news for the bank's part. So this definitely wasn't great news for those in variable rate mortgages. There's been a few articles out this week that variable rate mortgages have boomed throughout the pandemic, and with quasi-good reason. If you're in a variable rate mortgage right now, you're probably at prime minus 1.1, minus 1.2. So with prime at 2.45, you're probably paying about 1.25%. Given that our real estate prices have skyrocketed throughout the pandemic, that's definitely made your mortgage payments be a little bit more manageable. Until maybe now. If the Bank of Canada has to start raising rates, and by all looks of it, they're going to have to, some economists are even predicting 2 to 3 rate hikes in the next year, that could cause a real problem for people in variable rate mortgages. They were great during the pandemic when rates were low, but as rates start to inch higher and higher, that's going to definitely change the payment structure. Just as an example, the average house price in London, Ontario, my hometown, is around $640,000. So if we look at minimum down payment requirements on a 25-year amortization, and we change the payments from 1.35 to a 1% rate hike at 2.35, we're looking at about a $300 a month difference. That's where a lot of people live. That could cause a big strain on people's budgets. So if you're in a variable rate mortgage, the inflation data today definitely wasn't great news, and it very well could be worth locking in. Contact your mortgage broker or your bank to see what your options are. But as inflation data gets higher and higher, it becomes more and more likely that the Bank of Canada is going to raise rates to tamp that down. For its part, the U.S. Federal Reserve saw inflation data come in over 5% last month, and if Canada follows suit, which we usually do, if Canada's inflation data follows that of the Federal Reserve or of the U.S., then we could be looking at 4, 5, 6% inflation in the coming months. So it definitely might be time to lock in if you're in that variable rate mortgage. And judging by the news articles, a lot of people, more so than usual, are in variable rates. So definitely look into locking in. Just to see maybe it's right for you. See if it's within the budget, if that's something that will help your finances. Given the higher price at the pumps, and I think everybody's seen higher food prices, obviously shelter prices are higher, and with shortages there are going to become higher wage demands, etc., etc. This inflation is likely not to subside anytime soon. We do plan on hearing more from the Bank of Canada on October 27th when they release their quarterly monetary report. And they'll also have some predictions in there for Canadian real estate, which we're definitely going to go over. So make sure you click like and subscribe to get that update. And thanks so much for watching.